Hey there, Happy New Year, everyone. This is Trader Tim from EminiMind, and I wanted to kick off the year doing a recap of my 2023 stats and go through kind of the spreadsheets, a little bit more analytical, talk about some of the kind of key takeaways from last year, and we'll go through some of the numbers too. So before we do that, let's just take a look at the bigger picture, where we're starting the year off here. Basically at all-time highs. The COVID lows, you can see, drew us down, or we from the COVID lows to all-time highs prior, drew us down to the 50% retracement, and that has a target up at 54.18. And it doesn't seem that far away. It seems like a big number, but we're certainly on our way, well on our way as we start into 2024. Whether or not we'll get there in a straight shot, like we've been kind of going up the last couple of months, or more than likely it'll be some more undulation and some pullbacks along the way, which we like to see. So that's kind of the bigger picture where we're coming into. I don't think anyone expected 2023 to be a strong up year, but that just really embeds the importance of staying in the market. If you want to be a participant in the long term, which I'm a big advocate of, it's great to trade and have a trading account, but you probably don't want your entire net worth in your trading account. And I find that I trade much better when I have kind of a bigger picture mapped out and these different buckets or pieces of the pie where I put my money, so the income comes in, whether it's from trading, other businesses, wherever your income's coming from, and then dispersing that income every month to different buckets. And with that comes a piece of the bucket, or a bucket, which for me is a long-term investing account. Could be your 401k, and in that I just use Vanguard Growth Fund. We can take a look at that's VUG, which most of you know. VUG is what I use in there, and just look from the start of the year to the end of the year. A little bit more weighted in tech, but very much a strong up year. And so if I had gotten scared and sold out at the end of 2022, you miss all of the gains, and then that really kills your average, your long-term average. So it's good to stay in the game. If you want to do some swing trading along the way, that's great. Put that money in a separate bucket or a separate account, and you can swing trade options, stocks, whatever it is. But I find that it's really nice to have a little boring old long-term account where you pile up money in and it just kind of chugs along, so that takes some of the pressure off your trading account specifically. So that's the bigger picture. Let's jump into some of the stats from last year, and I got a few key takeaways that we'll talk about too. But we'll start with so I basically have three strategies. The first one is the retracements that we do on the 512 tick chart. So that's this chart on the right. The 512 tick is where I'm executing. This screen setup is basically what I use for all my trading. I'll toggle the middle one, as most of you know, between like the 15-minute chart, and lately this last year I've started including 1-minute chart and taking trades on the 1-minute chart, looking for inverted hammers up at highs, hammers and double bottoms and things like that down at lows. So we've got the retracement trading strategy. That's number one. The 15-minute trading strategy, the opening range breakout. That's the second one. And then most recently, that 1-minute trading strategy where we're buying above the high of a hammer or selling below the low of a hammer. And so with that, the for 2023, the general kind of numbers that I look at, winning percentage, losing percentage, obviously, then R multiple, expectancy, and then just the monthly numbers. The overall trades have come down over the years, and it's something you've probably heard me say for the last couple of years. If I just go back, I've got these all kind of down in the stat section, and you can see number of trades, 218 for 2020, and then as I go forward, 174, 2021, 136, 2022, and then this year only 85 trades, only 85 retracement trades. I always start the year, the first week I don't trade, I just watch. and then start building up, ramping back into my trading. But you can see there's a lot more holes and even weeks with very few trades as far as retracements go. And one of the reasons for that last year was because volatility was so much lower. We started climbing, and when you climb, when the market's going up, you tend to see a drop in volatility. So coming off of 2022, we had a lot more volatility because we were trending down. There was a lot more swings, both to the upside and the downside. That's one thing people forget. The biggest up moves are going to come in the context of a downtrend, and some of the largest down moves can come in the context or coming off of an uptrend. So typically in a down move or a downtrend, you're going to see higher volatility, whereas this last year in 2023, especially as we got to the middle of the year, we started to see a real big drop in volatility. So that kind of, it both decreased the number of trades here that I had, but it also decreased the R multiple, or the reward to risk. So you see that number here dropping just below 2, but if we go back to the older years, just above 2 in 2020, last year 2.17, and then in 2021 it was also just below at 1.84. Number of trades per month, if I go back to this year, you can see in the middle of the year, kind of even some of the early part of April and May, starting to drop, mostly in May, into the summer, dropping quite a bit, and then picking up a little bit in the fall. And then December, I only traded the first 2 weeks. I was in Mexico the third week, and then I don't trade between Christmas and New Year. So a pretty big drop in the number of trades, and just kind of overall total points. So the points that I use, so if you go in the member dashboard, I have this Excel sheet in a Google Doc, all this info pasted in there, and on the bottom are the different tabs for the different years, so you can go through and go compare. I've got the date and the time if you want to look at your trades, compared to these. But the let's see, I forgot what I was going to say. But nonetheless, the all the trades are there, and the number of trades certainly has come down. Oh, as far as the points go, on the ES trades, the retracement trades here, these are all in 2-point increments. So the total net points are for trading 2 contracts. So not 2 points, 2 contracts rather. So the first contract is going to be your first target. The second contract is going to be your trail. And I've divided it down that way for this sheet so that it's easier for you to kind of compare. So if you're trading 4, you just double the number. I usually trade 6, so you just triple that number. And so all of the retracement trades here are in 2 contracts. The 1-minute chart is just 1 contract. I just divided it down to 1, and so that, from a point perspective, on the 1 minute, so like the retracements, 350 points for the year, with 2 contracts. But then on the 1 minute, I only started trading that in March, and amassing 200 points over the course of 3/4 of a year, and only with 1 contract. That was actually really solid, and that made up for a lot of gap or lack of trades in the retracements. So like, let's say I was just on March. So March, third week in March, 22. Is that right? Might have my date off here. 22, 21. Something's goofy there. 29. 19, let's go to the beginning. Oh, May, that's why. That was supposed to say May, not March. We'll go to, just pick a random week here, 15th of May. And 15th of May. So you see here, just kind of picking a random week, only 1 retracement trade that week. But then look at the 1 minute on that same week. A lot more trades. Not a huge week, but just kind of filling in the void, 8-pointer, 6-pointer, coming away with a few extra points to kind of make up for that gap in or lack of trades due to a little bit lower volatility. If we kind of pull in the 15-minute, just random curiosity here, May, what did we say? It was 15th? May 15th. So that one, a little bit of a down week on the 15-minute. The 15-minute is also in 1 point increments, but you can see that a few more trades. So by the time you take into account the 15-minute, the 1 minute, and the retracements, now you kind of build up your trade count and your trade volume. The 15-minute had a kind of a slow summer, and that was very much impacted by the lower volatility. When you account for taking the opposite trade, so these trades here are the trades if you take the first break of the 15-minute opening range breakout. So like today, we opened, we broke to the downside. That would be the down move is the first break. And then this opposite column over here, this is if you don't make it to the plus 20 target, if you trade in the other direction. So when you kind of combine these two together, that would give you the sum of the week if you're trading the opposite of the 15-minute as well. So that kind of gives you the potential for two trades off of that 15-minute opening range breakout. And so the 15-minute had a lot lower P&L for the year, about 100 points, but then with the opposite included, that was also about 100 points. So about 200 points for one contract on the 15-minute opening range breakout, compared to 2022, where we were up in 300 points, and that wasn't even trading the opposite. And 2021, that one was also, I don't know if I have that pasted here. Yeah, almost 300 points on the in 2021. So a big slowdown with volatility kind of led to fewer points in the 15-minute. But again, you start compiling. Okay, you got the retracement trades, the 1-minute trades, and the 15-minute opening range breakout, and all of those can be managed in the first 90 minutes, and you start to build up a much bigger pool of P&L. And one thing I noticed about the 1-minute is I really didn't have any major drawdown weeks. A couple small losing weeks in here, but the nice thing about the 1-minute, if you're going to trail each candle, meaning you get in the trade, and let's just say this isn't a true hammer, but let's just say you bought above the high of this low bar, and you trailed below each candle in the trend, you're getting your stop move so quickly that your losers are pretty small, and within a matter of minutes, you're already potentially in a winning trade. The other thing we talked about with the 1-minute is that you could trail swings as well. On the 512 tick chart, we do a combination of half the position gets a first target of 3 points, and this is all for the ES. Then the other half of the position becomes your trail, and that becomes very helpful to smooth out your P&L. You're not just waiting for one big home run trade, one big runner to give you, to make up your whole week or your whole day. You by splitting your position up in half, you get those small first targets, and you still have the potential for a runner. And so with the 1-minute chart, I've always trailed the entire position behind each candle. So I get in, I move my stop for all the contracts, and I trail all the contracts the exact same way. But the last couple months of the year, I was looking at what would happen if I trailed my stop behind swing lows. So didn't really come into play super well on this run up, but let's just take this run up for example, and you have a little bit more of a pullback here, then a rally, and then a pullback, and then another rally and a pullback. And so if you were to trail your stop below the swing lows instead of trailing each candle, you can stay in some of these trades longer for more of a home run and a bigger runner. But I trade most days, but there are some days where I'm not able to trade, or I do take a break. And so if you only trail for the home run with whatever strategy you're using, you could miss that one trade that makes up your whole week. And so that's where on paper, if you look at every single day, the runner, just trailing the runner is going to be more profitable on paper, but in real life, it just doesn't work that way. It's much more profitable to split the position, for the retracements. That's what I've done for 10 plus years. And so the with the 1 minute, if you want to trail swings, I would encourage you to look at splitting the position in half. It's a little more a little more work than just trailing all the contracts, but you're gonna help smooth out that P&L curve and be more consistent over time. I would much rather have a lower peak and a higher valley, like not be so deep in the drawdown. And the trade-off for not having such a big drawdown is not having such a high peak. I'd rather that kind of sine wave be closer together. If you picture like a sine wave on a 45-degree angle, so your P&L is going up and to the right, but to try and decrease the peaks and valleys is more valuable to me than having a $20,000 week and then a minus $10,000 week. I just rather be more consistent. $5,000 profitable week and a minus $1,000 is the worst week. So like bringing in those peaks and troughs is much more valuable to me, and it helps me stay more consistent over the month. I'm not having these like big emotional highs and lows either. So if you're looking at trailing, if you can find a way to split the position in half and kind of do a little bit of both, that's going to be the best approach. But overall, I was happy with the year. The rules and everything kind of stayed the same. I don't really change the way that I trade. I'm just trading in the first 90 minutes of the day, and then the number of trades came down, but I was okay with that because average points, that's 2 contracts, so not a huge number in itself for just the retracement trading. But you take this, even if you're just trading 4 contracts, you take that 17.7, take off 25% or 20% for taxes, and then let's say you double that to 4 contracts. So let's just say that's closer to 30,000, and then you add in some of the 1 minute trades, and maybe you don't take all the 1 minute trades, but you tack on another 10 or 15,000 from a couple contracts with 1 minute trades, and then you take the 15-minute opening range breakout every day, you get another couple hundred points from that, and all of a sudden you're up easily in the 75 to $100,000 range of income potential with just trading 3-4 contracts. Like, it doesn't have to be a huge number of contracts if you can be consistent and limit your drawdowns. And that's one of the things that I really value in my own trading is yeah, I have losing trades in here, but they're never very big, and they're always fairly sparse. And I'm okay having no trade days within my trading if it means that I can keep plugging away, taking a few points at a time, and occasionally getting a bigger 10 plus point, more of a home run trade in the mix. But definitely some takeaways from last year were there were a lot fewer trades, a lot more holes in my trading on specific trading strategies. And so having the 1 minute and the 15-minute in there was really helpful to kind of fill some of those voids. Splitting your position in half if you're going to do a first target and a runner has been very well, and it's also proved to show promise in the 1 minute trading as well. And then the third thing is just limiting your drawdowns as much as possible. Giving up some of the winners, I'm okay with that if it means I can limit my drawdown. So that's some of the takeaways from 2023. I hope you have a great year in 2024, and feel free to drop your questions in the comments, and I'll answer those as soon as I can. So thanks everyone, and have a great year.